Well, hello, everybody. I'm Mike Greenlay. Welcome to the Tradition Company's Going Vertical podcast. It's my great pleasure to once again have Erik Hendrikson, president of Tradition Mortgage, with me. And our special guest today is Jason Dario. He's a senior partner and COO of Tradition Mortgage. Welcome to both of you gentlemen. Obviously, it's been a crazy, precarious, interesting, I don't know, you could add any adjective you want over the last 2 years. But recently, because of the factors that are out there, we've seen a lot of spikes in mortgage rates, and there's a lot of other factors that come into that. So, Erik, can you do me a favor and just kind of give us a quick little rundown of how you see things in the past little while?
Thanks, Mike. Well, really, I call this kind of the lowdown on higher rates. That's the topic of conversation that's going on with anybody that is looking to buy a home right now or build a home, is, you know, what's going on with interest rates. So that's why we wanted to kind of talk about it today, is just maybe shed a little bit more light on what that is. And it's pretty complex, all the factors that come into play when determining the direction of mortgage rates, and it's not something you can put into a 2-minute soundbite. You know, it's tough to put it into a 15 or 20-minute podcast, but we'll try. But just long story short, we've seen a historical rise in interest rates in a very short period of time here in 2022, really starting in January to where we are now. 250 basis points plus 2.5% higher interest rates compared to where we were at the end of 2021. And, you know, that obviously sounds very alarming, and to some degree it is, but I think it's really important that we broaden the lens a little bit and we look at where we've been over the last 2 or 3 years, and that, you know, what people kind of forget is prior to the pandemic, as you go back to 2019, our interest rates were up in the mid fours at that point in time, and even as soon as or prior to that, after the Trump election, we had rates that were pushing 5% back then. So really, historically, we're not that far off being kind of in the low to mid fives for a 30-year fix. But we did see a massive spike, and, you know, what we're trying to explain to people today is what happened, and more importantly, I guess what are the factors that are going to go from here on out forward, determining, you know, are rates going to keep rising, or potentially are we going to see them come back down?
And Jason, once again, welcome to the podcast. Can you give us your kind of view on how things have gone from your perspective and what you do with the company, and how you kind of look and project and try and sort all of this out?
Thanks, Mike. Well, we obviously work with a lot of third parties. We have a hedging firm out of Denver. We've got constant data and input and stuff that comes to us to stay abreast of what's going on, know trends, predictions. A lot of it is in a little bit, we're kind of in a unique period. Maybe when you look back historically, even into the early 90s, I believe it's the steepest rise in the shortest period of time in rates, going all the way back to the early 90s. So maybe not the steepest rise ever. There was stuff back in the 80s and stuff that, was crazy, and we wouldn't even, it's crazy to see how much that rose. But this is kind of a time that kind of shocked the industry a little bit because it went up so quick, so fast. With that said, I mean, you've got factors that have never been in play, because none of these other historical events going back to the early 90s, even in the late 80s, had coming off a pandemic also. So one of the factors that I think everybody, no matter what, everyone talks about the Fed. As a Fed, did they wait too long? Did they do this? Well, they moved when they were firing a bazooka to solve a world pandemic and not really worry about what was going to happen after that, because they were trying to solve something right in front of them. By doing that, I think it's kind of the one thing that's making this different than things in the past, when you say, well, historically, every time this happens, then this is going to happen. That's what makes this unique, because every time that happened and this happened doesn't apply when you say plus throw in a pandemic. So all these leading indicators say every single time this has happened and these three indicators are showing up this way, that's going to be a recession within 10 months. Not saying that's not going to happen. That's probably highly likely. However, there's that other factor of the pandemic. So while everybody's trying to make predictions, everyone's trying to see what's going on, I think it's key to see the quick, early, fast rise in something when all of a sudden everything shifted, saying, wow, it got there really, really quick. And in some ways, that's maybe a sign of, hey, is this kind of I don't know if you want to call it like a preview of, hey, this might just get there real quick, just like a knee-jerk reaction. And then as things settle in and there's some data that looks in the rearview mirror or looks out a little bit, you're going to see it come back to stabilizing. And that's kind of the hope. That's where a lot of economic gurus are predicting that, hey, maybe we're getting near a top. And I don't know if that's in the mortgage industry safe to say by any means, and I don't want to make that statement. I do think there's probably more upside here in rates when it comes to just knowing if the Fed is really going to act, if they do follow through. They're historically notorious for saying they're going to do all this stuff, and Erik and I have talked about this a number of times, and then they don't. They say, we're going to raise at least this, and then what will happen is data dependent, they'll start backing off some of those. So if that does happen in this case, maybe we are getting closer to the top. If they do follow through, I think there's some more upside. But again, because it went up so quick, so fast, we're probably closer to the top than we would have been if it was a slow, drawn-out process. Still get to the same end result, and then we'll have to see how they go from here.
Just piggyback on that, perception, it creates a little bit of reality, and the reason the Fed never really raises rates to the extent that they may be threatened to is because the market reacts and kind of creates the more muted economic environment that the Fed is trying to basically foster by higher rates to just bring down inflation. And we saw that last week with a massive sell-off in the stock market. Is obviously inflation's higher and the Fed raising rates, higher borrowing costs for businesses, other things, so potentially companies aren't going to perform as well, and then all of a sudden the stock market sells off and everybody kind of slows down their business level and kind of achieves what the Fed would ultimately do by raising rates, just doing it almost organically right now. So I think that's certainly a possibility, and just to kind of back up, Jason was talking about the bazooka. What did the Fed do that was a bazooka? Those that don't follow the financial market super closely but want to buy a house and are wondering what's going on with rates. When the pandemic hit, they had no idea just the massive disruption that potentially would cause to the economy. Obviously, when you shut down an entire nation and put it on lockdown, obviously that's going to cause massive disruption. So by the Federal Reserve basically creating an ultra low interest rate environment, they just wanted to basically encourage economic activity, investment by businesses, make it really cheap for people to buy houses and spend on their credit cards. They were just basically kind of giving people a carrot to keep going, and they knew that eventually that subsidy would come to an end, but they wanted to make darn sure that the economy could stand on its own before they pulled back. And that was where the argument can be is like, did they wait too long to kind of remove that accommodation? And all of a sudden, now they put too much money into the economy and they made everything too cheap for too long. Obviously, if you got a 2% mortgage rate, you can afford to buy a really big house. And if there's buyers for really big houses, then everything becomes an expensive house. So by trying to normalize that now, where the Fed came out and said, hey, we're not going to be buying mortgage-backed securities, we're not going to be buying treasury bonds, so we're going to remove ourselves. Now the market has to organically find an interest rate yield that would bring in more private capital. So that's really what we kind of saw the first couple months of the year is the Fed kind of pulled off the throttle there, and then that brought rates up a good chunk, and then all of a sudden, boom, these huge inflation numbers created another issue, and that was probably the other half of the rate increase. And now the Fed's talking about having to really go on the offensive to make it, more difficult to borrow after 2 years of making it too easy to borrow. So again, it was the fastest decline in rates a couple years ago. Now it's the fastest, increase. So it's basically washed out, and we just have elevated inflation on the top that, to me, is really going to drive interest rates going forward. And there's certain expectations that are already built into rates. So really, it's, going forward, the thing to look at, in my opinion, is just where are the inflation numbers? The Fed can talk all day long about what it's going to do or not do, but ultimately, it's inflation that is, to me, is going to, really drive where rates go from here. And again, there's a pretty healthy expectation of inflation already built in these current rates. So if we match expectations or hopefully go a little bit lower, I think we might be just about to the top of the mountain here.
It's interesting. The more you see some of these, I guess I'm going to call them analytics or metrics or whatever you want to call them. I mean, we all laugh about how sports has just gotten to be, analysis paralysis. The mortgage industry and every other industry that relies on different kinds of rates. I mean, there's analytics for every little thing. And Erik brought up a few of them, and you got to focus heavily on some of them. And some of them are already baked in the cake, as he likes to say. And some of them are, well, we got to wait to see what happens this week. So, I mean, I guess, how do you manage around that? Because there is no shortage of indexes and consumer pricing things and every other thing you can think of. How do you work your way around those?
Some of it you have to take, with a grain of salt, because with media, the only people that get on the shows, get on the articles, get on the clippings or whatever, the headlines, are the ones that are on extreme on either end. You don't turn on, you're not watching CNBC, which obviously we all watch a ton in our industry just because rates and stock markets and money flow. No one gets on there and says, I think we're kind of getting in the middle. It's, it could go either way. You're either going to get on there as rates are going, let's just say they're talking about housing, and rates are going to go to 6.5. Or rates are going to go back to 4. No one's going to get in there and say, I think they're going to hover around 5 3/8, 5.5 for 6 to 8 months. They're not going to get the headline. No one's going to see, coming up at the bottom of the hour, somebody thinks we're going to settle in right where we are. You got to say something extreme. And I think that's what's so hard to navigate. And when you get the data, when you get the information, we read it all. We have to try to see, are there common themes that many of these economists and analysts are saying that are consistent, because some of the extremes you have to just throw out. But I think one of the big things and one of the myths is, the Fed could raise rates, 250, 350 basis points more. And I've had this conversation with a number of people, and that say, oh, well, that means rates are going up 300 basis points. Short-term rates are. If they raise it, that's, home equity lines, credit cards, auto loans, all that stuff. Mortgage rates are not tied to what the Fed's doing when they're raising their lending rate, their overnight rate. It's indirectly impacted, but it's the biggest thing in this one is the Fed bought, as Erik said, so they put so much liquidity in the market. They bought so many mortgage-backed securities, which are where rates are really tied to. And as they stop doing that, that's one thing. And as they unwind, they need to find a seller or a buyer for what they're selling. And until there's a level of a ceiling that goes up, that rate needs to keep going up before a buyer will come in. And right now, the mortgage-backed securities and the 10-year Treasury trade there's kind of usually it's pretty similar. We keep bumping up against this ceiling on the 10-year, which kind of multiple times we've touched above 3%. And then we get above it and we hold a little bit and then we come back below it and we kind of keep it. So it's almost like we're testing a ceiling, possibly. That's one of the things that's somewhat cautiously optimistic, that we keep bumping against the ceiling. And as they unwind that, if that ceiling can hold, that means we're closer to maybe a top. Now, if they unwind it and that ceiling busts through a couple key indicators, there could be a new ceiling set. And that's where all the people that sit there and stare at the numbers all day and they chart that stuff, they graph it, and then they come out and produce their information. And then the people that are we'd call them the spokesman will come out and portray that for the media, and they'll say what is going to get them airtime. And again, there's truth to everything they're saying. It's just you can't get too caught up in the headline. Because the headline, that you can get caught up in a headline if it says, here's the actual number and the statistic that came out. But when you're talking about predictions, even when you watch it on the jobs report, they'd have 6 or 12 people. Every one of them will be wrong. Some will be over, some will be under. Every once in a while, someone will be close. And then they'll be back the next month. These are just people with their data and analysts. Yeah, and they're just trying to. And again, what are we doing at 7:30 on the first Friday of every month? We're watching the jobs report because it's another indicator that kind of impacts the market and economy. So you do your best to try to take all the information in and break it up and chop it up and try to manage the way we can with what the best info we have is.
I think, Mike, to your question about like what's an index or what can be looked at, what is the average person out there is just trying to kind of get a feel for the direction of rates. What can you look at? And Jason mentioned it, but the 10-year Treasury bond is often viewed as a very close proxy for interest rates. And the 10-year Treasury bond, like Jason said, has been hovering right just below 3%. So it's not, mortgage rates are not 3%. Typically, there's a spread of about 200 basis points, give or take, to kind of come up with your typical average 30-year conventional Fannie Mae mortgage. So that, if you had a 3% Treasury, it'd be about roughly a 5% mortgage. But people are like, hey, what gives here? The average conventional loan rate's 5 3/8, 5.5 right now. That's elevated. Well, it goes into the situation that, again, people think it's just banks that make these loans for house mortgages, and it comes from the deposits that banks have on hand. Well, the U.S. housing market demand would far outstrip the ability for all collectively the nation's banks to make home loans with their deposits. The money for all of our house mortgages, for the most part, comes from the capital markets throughout the world, and they buy mortgage-backed securities or mortgage bonds. So these loans that are made get put into pools and sold off on the capital market in the form of bonds. So the reason that we're able to enjoy such liquidity and access to home loans is because we're tapping the entire world financial markets to get capital for our houses, which is pretty cool. But it also means that we're constrained by what's the interest rate environment of the globe. Quite frankly, what is a global investor? What does somebody in China or Japan need for a bond yield? Are they going to buy our mortgage-backed securities or not? And if they don't want to buy them, we're going to have to pump up that yield. And over the last few years, our Federal Reserve was printing its own money to buy mortgage-backed securities. So we were setting our own rates for mortgages. And as the Fed backs out, now it's the capital markets of the global economy that are determining what is an interest rate that they want. And what we've seen is because, the Fed stepping out, that spread between the 10-year Treasury bond and the Fannie Mae mortgage-backed security, that spread's elevated. It's closer to 2.5% right now. The good news is, there's less supply. That demand's gone down a ton, but with rates being higher, there's less mortgages being originated. So guess what? There's less issuance of new mortgage-backed securities. So thank goodness for that, right? Because that supply is bringing down, and that helps, basically, come down to the demand side, because the demand dropped off the table with the Fed getting out of play. And now if you had a whole bunch of supply, that would even drive rates higher. But again, with less mortgages being originated, it's going down. So hopefully in the next, 12 months, you'll see that spread between the 10-year Treasury and the 30-year mortgage-backed security come down closer to that too. So even if interest rates in general go up a little bit, but that spread tightens, that'll offset and maybe even give us a little bit lower mortgage rates. So anyways, that's a pretty technical look at things. But if you want to look at kind of the future predictions and forecasts for the 10-year Treasury bond, you can throw that spread on top of it, and that'll give you a pretty good idea of where the capital markets think mortgage rates are going. And right now, I don't see predictions for that 10-year to really spike too much right now. But again, it's driven by the global markets, and if all of a sudden there's further supply chain disruptions or there are changes in expectations of inflation, then you'll see things really start to get interesting.
That's what I love about Tradition Mortgage is you can always get educated, whether it's a loan officer or one of the principals or partners. But as we slowly wrap things up here, I wouldn't say Erik didn't throw wild predictions out. He kind of mentioned what he's going to be keeping an eye on. Jason, how would you like to finish off, and also what are you going to be looking at over the next short period of time?
Well, just to follow up what Erik said is the 10-year Treasury, which is a great indicator, because the 10-year Treasury is about as safe as an investment in the world. It's viewed as one of the most safe ones, and that's the one that majority's bought. So mortgage-backed securities are always going to provide a little higher yield than that, because they're not quite as, obviously there's more risk than a 10-year Treasury. So as why the 10-year is so important, and what you have to think about is when an investor or big institutions are buying that 10-year Treasury, if they're getting a 3% yield on that, that's for 10 years. They have to feel in their mind like that 3% return is going to be something that they're willing to put their money in for a longer period of time. Not that they can't sell in and out of it, but if the inflation numbers are running at 8, 9%, and they continue to rise, the 10-year Treasury's yield is going to have to go higher for those investors to buy it, which is ultimately going to push the mortgage-backed securities rates higher, which is going to continue to put rates up and put that spread like Erik was talking about. Whereas if they can start seeing it come the other way, when inflation starts going from 9% or 8%, and they start seeing it maybe starting to come back down the other way, and they see the trend is going the other way, you might see more of that private money coming into the 10-year, because to lock up a 3% yield when they know that inflation might be working its way back down to, hopefully somewhere in that target 2 to 3%. These investors, this private money, can actually out-earn inflation. And for the longest period of time, inflation's been running non-existent. So, there's just not an investment there that without the Fed coming in, there wasn't a market for it. So that's where they printed their money. But I think that's the big thing, is really watching that 10-year is the one thing, not just from what it is daily, but what the predictions are, where the money's flown in. When the Fed really stops buying and then starts reducing their balance sheet, as they reduce it, the buyers have to come in. And if that doesn't go well right away, okay, that's a little bit of a scary situation. Not scary, but maybe a little bit nerve-wracking. And also when they're offering these every month, there's 10-year, 7-year, 5-year bond auctions. The grades on the bond auctions are one thing that kind of a sneaky way to look at. If it's not really attractive and it gets a bad grade, you can see it, then that means there wasn't a demand for it, which means they're going to have to continue to have that rate go higher for it to create demand. So that's a way someone could use a technical thing and say, if you're sitting around a campfire and you want to talk smart, is like, there's an auction for the treasuries this week. Was it a good grade? What does that matter? Well, if it's a good grade, if there was a high demand, that's a chance that means that rate, wherever it is kind of where the market is kind of hopefully stabilizing without some unknown factors coming in. So I don't know if I necessarily answered the question, but more of a politically answered one.
Absolutely.
Well, the one thing this is the other side of it too, that we have to watch for is recession. So right now everybody's talking about inflation's going wild, and the Federal Reserve is taking steps to make it more expensive for businesses and people to borrow. And, you're starting to see, some cracks, sell-offs from the stock market. But if we get into a situation of a recession, meaning a decreasing economic activity where things go the other direction and things slow down, as fast as these rates have gone up, you're going to see them fall, because there's a certain thing called safe haven investing. And as Jason talked about, U.S. Treasury bonds are not even so much viewed by the world capital markets as kind of an investment opportunity for yield, but it's a place to park billions of dollars of capital to keep it safe. And they want to get as much yield as they can, but more so than not, they just want to keep it in a safe situation where they're not losing principal per se. So if the stock market starts to tumble and economic activity craters, you're going to see a big rush into the treasury markets and mortgage-backed securities, because they're viewed very similar, especially with the U.S. government having kind of stepped in to prop up Fannie Mae and Freddie Mac. But you're going to see world capital markets really start to grab those, and you're going to see rates plummet. Now, if you're buying a house, that might sound great because rates are going low, but we don't necessarily want to plunge the world or the U.S. economy into a global recession, because that means potential job losses, all kinds of other bad things. But if we do go that direction, that is a risk that we could see a major recession, and the only silver lining to that is that you could see rates go back down, probably not to the point where they were during the pandemic because of obviously the active activity of the Federal Reserve buying them. But you know what? You're probably not going to be too tremendously far away. But even though we're in the business of making mortgages, we don't want that to happen. We'd rather be selling higher rates and have a healthy economic situation, healthy job market and housing market. And again, we're just striving for balance. And just like Jason had said, you don't maybe make headlines by going and saying, hey, we're just going to kind of ride in the middle with small tweaks here and there. But that's certainly what we're hoping for.
Well, gentlemen, clearly we're going to have to revisit this somewhere in the near future, because as you guys all said, there really is no cycle to kind of rest on, to go off of. There's a few things here and there, obviously, but the future is very, very unknown. So we'll definitely revisit this. But Jason, thank you for your time. Appreciate it. Erik, once again, thank you for joining me and co-hosting this. And we'll be back with you again, hopefully very soon. Thanks for listening to Tradition's Going Vertical podcast.